Before I begin, be sure to like the video and leave a comment on what you think of it. Also, be sure to subscribe to my channel and ring the bell to keep up with further audiobook readings.
Chapter 6: Why Whole Life Insurance Beats the Alternatives. There are many options out there for saving and storing your money. So why do we focus so much on the one, whole life insurance? What makes it so much better than the alternatives like 401ks, IRAs, and the other types of life insurance that are available? Most people put their money into a qualified retirement plan, such as a 401k or an IRA. The problem with these plans is that the accounts are heavily invested in mutual funds. You may think that you have $50,000 in your retirement account, but what you actually have is $50,000 worth of shares in the mutual fund. If the market goes down, those shares could drop in value and all of a sudden your money is halved, which is what happened to many people in the 2008 financial crisis. Money kept in a cash flow insurance policy, meanwhile, is hardly affected by the stock market. 401ks are also inferior due to their lack of liquidity. When you put money into a 401k, it's locked away until you're 59 and a half. It's possible to take out a loan of your 401k before then, but not without consequence. You may not be able to contribute to your 401k while you have an outstanding loan. If your money was earning at all while in your 401k, you will lose those earnings while you have the loan out. And if your 401k is through an employer and you're laid off or quit that job, you may be left with 60 days or less to pay off the loan, or be hit with a 10% penalty plus a tax bill. And the truth is, 401ks are on their way out. In 1970, about 45% of workers had a pension plan, which would provide a permanent income in retirement. But as the average lifespan grew, these pension plans became more and more expensive. By the late 1970s, companies began to switch over to 401k plans, which enabled companies to set aside their money into the 401k as part of the employee's paycheck. Then stock market returns would fund the employee's retirement instead of the company having to do it. This worked well as long as the stock market was also doing well, as it was from 1982 through 2000. But from January 14th, 2000, the day the stock market reached its highest point in 2000, to January 14th, 2015, the stock market was up to 8.4%, adjusting for inflation, or just 0.54% per year. That return is not enough to fund a retirement. And so, like the pension, the 401k is reaching the end of its days. There is only one method of saving money that has survived for over 100 years, that lasted through the Great Depression and through the 2008 recession, and that is still going strong today: whole life insurance. Mutual funds, ETFs, 401ks, and IRAs have only been around for a few decades. Life insurance, on the other hand, is one of the oldest financial products in existence, with sales beginning in the US in the late 1760s. It has survived 2 world wars, a revolution, a civil war, depressions, and recessions. During the Great Depression, over 9,000 banks went bankrupt. By contrast, only 2% of the total assets of all life insurance companies in the United States became impaired between 1929 and 1938. In fact, the strength of the insurance industry is a big part of what helped the economy survive and recover. The same thing happened during the 2008 financial crisis. Of the safest insurance companies, only 1% had investments that were non-performing. The financial crisis did not affect these companies, and they were able to continue paying out dividends. Not all life insurance companies are created equal. There are two types: stock life insurance companies and mutual life insurance companies. As the name would imply, stock life insurance companies trade on the stock market, just like any other public company. Hartford, MetLife, and Prudential are all stock life insurance companies. Mutual life insurance companies, on the other hand, do not trade on the stock market. You can't buy them in your 401k because they have no shares. They're similar to credit unions, except the policyholder is an owner in the insurance company. For good reason, mutual life insurance companies are my preference of the two. Stock life insurance companies, while they want their customers to be safe, also want to give their stockholders higher returns on their investments or split dividends between stockholders and policyholders. In mutual life insurance companies, on the other hand, the policyholder is an owner, not the stockholder. Profits are not split with any outside shareholders. While they still generate profits, stability and safety are the ultimate goals, and all the profits go to the owners, i.e., the policyholders. Mutual life insurance companies are among the oldest companies in America. Of the top 35 life insurance companies in the country, the average age is 106, with the oldest being 177 years old. 19 of the top 35 have been in business for over a century. As these numbers would indicate, these companies are incredibly stable. Statistics drive the profits. As long as the equations are correct, these companies make predictable profits. They have a very small part of their accounts in the stock market, so their value isn't as volatile as the stock exchanges. And since there are no shareholders, Wall Street analysts and money managers cannot pressure these companies into making short-term, short-sighted decisions. Therefore, these companies are free to pursue long-term strategies and are able to be conservatively managed. They don't use margin and leverage, and they generate large amounts of cash, which they pay out in large dividends every year. Life insurance is at the heart of building financial security and independence today and for the future. But most people don't understand it, and therefore many don't consider it essential or important at all. The number of people who have life insurance has fallen from 72% in the 1960s to just 44% in 2010. People tend to fall into four categories when it comes to insurance. They hate it and avoid buying it whenever possible. They hate it but begrudgingly buy the minimum amount. They like it but don't use it properly. Or they understand it, love it, and use it to its full potential. Before we get into more detail about the different kinds of life insurance, the most important aspect of insurance is buying the right amount. Only after you determine the right amount should you even think about the right type. The first concern when buying life insurance should be buying the proper amount of death benefit. When making this decision, you must consider not only price, but cost and value. Price is what we pay. Cost is the actual bottom line. We are a price-sensitive economy. Just look at Black Friday, when people buy things they never intended to buy just because they're low-priced. But low price often comes at high cost. The Levi's in New Orleans are the perfect example. They were built and maintained at a low price, but the cost when they broke during Hurricane Katrina was much higher. It would have been better to have the higher price and better Levi's. The difference between price and cost is pretty easy to understand. the concept of value is much harder for most people to grasp. Value is the real overall effect, not just the internal rate of return, but the external rate of return as well. Not just the money, but the larger effect across all areas of life. Most people, strategists and policyholders alike, only look at the price of permanent insurance. They ignore the cost and the value. When you are buying insurance, you have to consider the value of what you are buying, not just look for the cheapest premium. If insurance didn't cost anything, most people would get as much as they could get. It's usually not a matter of whether people like it or not, they just don't like paying for it. But we'll tell you where you really pay for it, when you don't have the right amount and something happens to you. Ask yourself, if price weren't an issue, would I want to protect my family and my own economic or human life value? Plan for your best case economic value and how you can replace that value, the income that you are currently earning, if something were to happen to you. If you died, would you want to leave your family in the same financial situation they're in currently, a worse financial situation, or possibly a better financial situation? Human life value represents your economic value to the world. Think about how much money you are making on an annual basis today and about the services you are offering to your clients and the people around you. How much value would you take away from the world if you were to die tomorrow versus if you were to live and work for another 30 years? That is your human life value. We'll talk more about how to calculate and determine what's the right amount of insurance in the next chapter. Now, when it comes to types of life insurance, there are two categories. Term insurance, which covers you for a limited period of time or term, and permanent insurance, which covers you for the entirety of your life. If you don't know what kind of life insurance to get, don't understand the options, and don't plan to read the rest of this book, term insurance is probably your best bet for now. But if you're going to continue reading and learning how to make the most of your life insurance, then term is not the best way to go over time. Term insurance is basically a bet. Policyholder versus insurance company. The policyholder is betting on a death, his or her own usually. The insurance company is betting on survival. If the insured person dies in the allotted time or term, the policyholder wins the bet and the beneficiary gets the money. If the insured person survives, the insurance company wins and the policyholder loses all the payments they've made. Now, policyholders make this bet knowing and hoping that they will probably lose. So why do they make it? Because it's cheap, and they know they're providing financial protection for their family if the insured person dies. Term policies are therefore the most popular type of insurance policy today, with 10 or 20-year term policies being the most common. Of all the term policies published, of all of these bets made, only 1.11% end with a payout to the policyholder. In other words, the insurance company wins the bet 98+% of the time. One of the most popular pieces of advice about buying life insurance is to buy term and invest the difference. Financial planners tout it all across the map. Retirement planners teach this strategy because the premiums on term insurance are so much lower than those on permanent insurance, especially in the early years. So their advice is to buy the lower premium term insurance and invest the difference in cost into a security or another investment vehicle. Here's the problem with this strategy. Let's say you bought a 30-year term insurance policy with $1 million death benefit. Your goal is to maintain this death benefit for the 30 years, invest the difference, and then cancel the term insurance. the interest rate you would have to make on your investment in order to match what you would make using a cash flow insurance whole life insurance policy would be a whopping 9.8%. It is highly unlikely that you are going to find that percentage in any investment vehicle, net of fees, taxes, and let alone a safe, stable, and liquid one. Term insurance, in general, is very problematic for a number of reasons. First, the cost of term insurance rises dramatically over time. If a 30-year-old buys term insurance, when the term expires, their rates may be more than 10 times over the original premium. So buying a new term insurance policy becomes prohibitively expensive over a person's lifetime. So when you're likely to use it, it becomes out of reach. Indeed, by the time a person reaches retirement, they may find that their term premium payments actually exceed their death benefit. If you look beyond the low cost of the early years of term insurance, you'll find that when considered over an entire lifetime, it's actually one of the most expensive types of insurance on the market. Low initial price, very high cost for those who live. There is a particularly dangerous subset of term insurance that you may want to avoid. Group term insurance. Group term insurance works through aggregate rules. This means that if a large number of people in the group policy die at the same time, such as what happened in the tragedy of September 11, 2001, the firm can hit its aggregate and the insurance company will only pay out a certain amount total to the group. So even if each individual had hundreds of thousands of dollars of insurance, the company might cap the payout to the group at $1 million. So under a catastrophic circumstance in which too many people die, the widows, widowers, or heirs only get half or a third of what they thought they were going to get. Another problem with group insurance is that usually the policy is not portable. Often, if you're in a group where you're younger and healthier than the group average, you're going to pay higher rates because of the aggregate health of the group. In some cases, when this benefit is offered with your employment, it's worth taking. But when you're looking to buy insurance, group policies are not a good bet. So why do so many retirement planners recommend buying term and investing the difference? Many retirement planners make their money on assets under management and may not get paid on the insurance. They may not be educated on insurance, just as many insurance agents don't have the same level of expertise with retirement plans and investments, and therefore may only focus on insurance. With term and invest the difference, the entire strategy is based on dropping life insurance coverage anyway as a person ages and builds their assets through their investments. Term policies are designed specifically to be dropped, with the assumption that once a person retires, they will have plenty of assets with which to care for themselves, their kids will be grown and financially independent, and they will no longer have any income, so they will no longer need income replacement coverage. This is what is commonly known as being self-insured. We believe that to be self-insured is a fallacy. A person is either insured or not. Learn more with our bonus chapter from Killing Sacred Cows. Moreover, we believe that a person doesn't cease to have human life value just because their employment income stops. Term insurance is focused solely on protecting income rather than protecting human life value. The truth is, the more assets a person creates, the more they'll want to have the protection of insurance, just like the Rockefellers. It moves from income replacement to asset and legacy insurance, a topic we will discuss further in Chapter 9. Many retirement planners would respond to this by saying that a person can create even more assets by investing the money they would have spent on a permanent policy in things that they have a higher rate of return. It is true that there are investments that could yield higher returns. You could potentially get 10 to 12% on real estate or during certain periods with a mutual fund, while the guaranteed interest rate on a whole life policy is only 4 to 5%. However, those numbers alone don't take the whole picture into account. If you bought a 30-year term policy for $750 a year and then dropped it after the term, you would have spent $22,500 on premium. You are never getting that money back. What's more, you have lost the additional interest you could have made on that money had you saved it. And even worse, you have also lost the amount of the death benefit you dropped. And depending on your situation, you may not be able to qualify for insurance coverage again, so you may have lost your chance of having a death benefit at all. Above and beyond this, permanent life insurance policies also provide all the benefits we have discussed. Benefits that you can take advantage of during your lifetime, including tax protection, disability protection, long-term care replacement, lawsuit protection, and the ability to utilize the cash value. Term insurance, on the other hand, carries no cash value within the policy and has no tangible living benefits. Moreover, permanent whole life policies provide that priceless asset, certainty, and that certainty can make you more productive in all areas of your life. Unlike term insurance, permanent life insurance is not a gamble. There is a 100% chance that the insured person will die, and permanent life insurance is designed to remain in force until the insured person dies. If you buy $1 million worth of permanent life insurance, unless you cancel the policy, the insurance company is guaranteed to pay out that $1 million or more someday. In order to make this payout, the insurance company collects money from you in the form of premiums while you are alive and invests that money. Basically, permanent life insurance is like a savings account, somewhere you put your money and grow it until you get it back again when you die. It's just a savings account that has a much higher return due to dividends than most. The return is tax favored, and as a policyholder, you are an owner in the company, so you receive a share of the profits. Of course, the question that most people have is, what's the use of saving my money like this if I only get it back after I'm dead? Well, the truth is that you can use the money accumulating in your policy anytime you want by withdrawing cash value or taking a loan out against that cash value in your policy, as we've discussed. Unlike term life insurance, where your premium money is gone forever, the premium money you're putting into a permanent life insurance policy is still yours to use while you're alive, and it will 100% certainly be returned to your beneficiaries after you die. No lost money there. All this being said, not all permanent life insurance policies are created equal. There are three main types of cash value life insurance: universal life, indexed or fixed, variable universal life, and whole life. Universal life policies include an annual renewable term insurance policy bundled together with a savings or investment component. Essentially, universal life is term insurance with a cash value. Ideally, what happens with a universal life policy is that the investment portion will eventually fund the insurance policy, with leftover money helping to fund your retirement. While it does provide some tax advantages over term insurance, you may still end up having to pay higher and higher premiums as you age. Either that, or the cash in the policy will start to go toward the cost of insurance and your cash value will diminish. Since the insurance is an annual renewable term insurance, every single year it can increase in cost. This means that whatever money you're putting into your policy, each year more of it may go toward the life insurance and less toward the investment. Moreover, if the market is not performing well or other conditions are not ideal, policyholders often end up paying big premiums in later years to keep the policy going. Universal life policies have flexible premiums and adjustable death benefits. The rate at which the cash value in these policies grows is determined by the insurance company and is based primarily on fixed income rates. This means that the insurance company can change both the rate of return and the cost of the insurance, which can result in predatory practices. The increase in the cost of insurance and the lower interest rates that are possible in a universal life policy can easily result in an increased premium or a lapse in coverage. If coverage does lapse, policyholders might not only lose the policy, but in rare cases can also end up having to pay taxes on any growth in cash value. The death benefit in universal life policies is also not absolutely guaranteed. Although you can add a guaranteed death benefit rider to your policy, if you miss a payout or borrow from your cash value, the majority of those riders are negated and the guarantee is voided. So universal life policies can work, but carry unnecessary risk unless you pay back the money you borrow, never miss a premium payment, or never borrow from your cash value. There is another kind of universal life policy called Variable Universal Life, or VUL. This was the first life insurance policy Garrett ever bought when he was 18 years old. A VUL has cash value that is invested in market subaccounts and has adjustable premiums and death benefits. The subaccounts vary with market performance, hence the name variable. Basically, it's a universal life policy with the added opportunity to invest in the stock market. Here's the problem. Unless you are someone who really understands the market and plans on actively managing those subaccounts, you would be more of a gambler and not really an investor. Even if you understood and had ability in the market, you would still have to deal with additional complexity of the VUL due to the expenses of the policy and increased costs against the policy in a down market. There is limited stability and almost no control over your returns in a VUL. The decline in the markets can be hazardous. It can result in an increase in the cost of insurance, which the policyholder must pay for, usually by selling off shares of their subaccounts. Of course, a market decline would mean shares are worth less, which means the policyholder would have to sell more shares. When Garrett was told to purchase a VUL, he was told that if he earned 18% annualized and compounded for 40 years, a mere $70 a month could make him a multimillionaire. What he learned very quickly was that the success rate for this scenario was approximately no chance in hell. It wasn't long before Garrett started calling it Very Ugly Life instead of Variable Universal Life. According to Garrett's senior thesis in his econometrics course, VULs have a 97.8% failure rate. If your subaccounts go down in value, your net amount of risk goes up. Insurance death benefit minus your cash value. Your average share value goes down and the cost of insurance goes up. VUL insurance exposes you to the risk of the market, which exposes you to rising costs of insurance. You have no guarantees because you may have to pay a higher and higher premium to keep your death benefit, all while your cash value is decreasing. There's no guarantee on the interest. It's an incredibly high-risk policy. This information is hard to come by if you talk to people who sell VULs. The illustrations and proposals typically show a much higher rate of return. Why? Because it doesn't show volatility, markets ups and downs, or it shows much higher returns than actually occur in the market. There are too many variables and factors that can destroy these projected numbers in a moment. Fortunately, my pain is your gain. You invested in this book and can learn the easy way, and if you're already in a VUL structure, a certified cash flow insurance specialist can discuss your options with you. If you want certainty, it's much better to have fewer moving pieces. That's where whole life insurance comes in. Rather than being composed of renewable term insurance, whole life, as the name suggests, provides coverage for the policyholder's entire life, guaranteed. Like universal and variable universal life, whole life insurance has a cash value. However, in whole life, insurers include additional guarantees from a minimal rate of return on that cash value to fixed premiums and a guaranteed death benefit. The top differentiating factors are that the premiums and the cost of insurance are fixed through the whole length of the policy, guaranteed. Whole life is not as flashy on paper as universal life or variable universal life. People are led to believe high returns only come with high risks, so words like guarantee and low risk make people think only of low returns. But the truth is, certainty, when understood and utilized correctly, has huge economic value. Whole life gives you control and certainty, and it transfers more risk away from you than any other life insurance contract. In a universal or variable universal policy, the insured takes on more risk when conditions change. In whole life, the insurance company takes on that risk. A whole life insurance contract is a unilateral contract, meaning that once you have it and know what your terms are, the insurance company can't change them on you, even if your health changes or the company's situation changes. The insurance company has to honor the promise they made to you up front. Whole life provides more certainty than any other life insurance contract. It is not affected by market fluctuations, the cost of insurance will never increase, and insurers can't take back dividends or ask for higher premiums or take away the death benefit. Even if you miss a payment, the guarantees are not negated. The premium is just taken out of the cash value, and the death benefit remains guaranteed. Another reason it is critical to fund the policy properly, as it will give you more flexibility earlier. Along with that certainty come tangible economic benefits during your lifetime, especially compared with the popular buy term and invest the difference strategy. With some simple calculations, it's easy to see how utilizing whole life as the centerpiece of your wealth infrastructure and saving strategies can outperform the popular buy term and invest the difference strategy. Check out Appendix 1 to see exactly how these calculations can play out to give you a permission slip to spend your assets and no longer be held captive to living off interests alone. With a whole life insurance policy, you have a guaranteed minimum interest rate, premiums that are guaranteed never to go up, a guaranteed death benefit, guaranteed cash value, and guaranteed access to that cash value. You have the ability to spend more and enjoy more in the later years of your life. And you have the certainty of knowing versus hoping, which has far-reaching benefits across all areas of your life, economic and otherwise, and benefits that reach beyond your life and onto the lives of your descendants, just as the Rockefellers have done.